So I bought my first precious metal at 10 cents, because I started changing the copper dimes in for real dimes, simply because I don't trust the Fed, I don't trust the Treasury, and I don't trust the government.
Precious metals have moved up in price over the years for many reasons, most of them not good. It has functioned for years as a medium of exchange and a store of value, and that's important to know. Most mediums of exchange that we use are abstractions, floating abstractions. Our mutual friend Doug Casey once said that the dollar is an IOU nothing, and the euro is a who owes you nothing. They're, in fact, promises printed on a piece of paper. Gold isn't a promise to pay. It's payment in and of itself. It has value separate and apart from a medium of exchange, which is important to know. You mentioned trust. If you acquire gold that you are relatively certain is what it purports to be, you don't need to trust the counterparty. It isn't a promise to pay, it's payment. What does move precious metals prices in my lifetime has been investors and savers' fears of the depreciation of their savings and investment instruments denominated in fiat currencies, but particularly, even on a global basis, denominated in US dollars during periods of time when there have either been negative real interest rates or the threat of negative real interest rates, either as a consequence of low rates or high inflation or both. Gold has done very well. And when you ask about why right now, I would suggest that there are 5 reasons why people need to be afraid of the maintenance of their purchasing power in conventional instruments, and why I think that gold and silver, pardon me, are much more likely to do well than poorly. If I may, I'll list them. Quantitative easing, which is a real fancy word for counterfeiting. If you issued Kiyosaki's and went around and tried to spend them in Arizona or wherever you are, that would be a felony. And they would plant you in a slammer. But if you were Congressman Kiyosaki,
there you go,
then this would be a highly popular policy, something for nothing, and you would be reelected forever. The next is debt and deficits. And this is arithmetic again, too. We have the dubious honor of having crossed $30 trillion in on-balance sheet liabilities with a budget that's in a deficit $3 trillion a year. I was taught as a young man, when you're in a hole, stop digging. But that is not what's happening. Many observers, Buffett included, has said, we're not going to pay this off. We're going to reschedule it. Any creditor, and I'm a creditor, who looks at a borrower, the US government, that has debts that they can't service and they're continuing to refinance them, becomes concerned about their principal. It gets worse. The worst is negative real interest rates. For the first time, Robert, in your life and mine, the government has made a promise to you that they're going to keep, and I'll explain that promise. If you lend the government money in the US 10-year Treasury, the base security in the world, the most important security in the world, they promise to pay you 2%, and they will, because they can print it. They don't have to earn it, they can print it. They promise to pay you 2% in a currency that, depending on which government agency you read, is losing its purchasing power at 6.5% a year or 7.5% a year. So they solemnly swear to reduce your purchasing power by 4% compounded a year for 10 years. And they will keep that promise. If you give them money now, they will give you back less later. That the market share of precious metals is the lowest that it has been in my lifetime. The consequence of that is that the market share of precious metals and precious metal securities relative to other savings and investment assets in the United States is less than 0.5%. Less than 0.5% of the value of savings and investment assets in the United States is in precious metals or precious metals securities. The 3-decade mean is between 1.5% and 2%. So if demand was to return to mean, not go crazy like it did in the 70s, Robert, when you learned about the gold trade. If the demand for precious metals returned to mean, demand would triple or quadruple. And there's one more that a lot of people overlook, and that is that after 40 years of really beatific economic conditions, the biggest investors in the world, the pension funds, the endowments, the insurance companies, operate on an asset skew that's roughly 60% equity, 40% debt. This is really where the rubber meets the road. If you are a great big pension fund and 40% of your portfolio is giving you a guaranteed negative yield, compounded, the ability that you have 20 years from now to meet your pension obligations or to service a whole life policy or to fund the maintenance of the Stanford University or Harvard University, or the ability of Norges Bank to look after the well-being of Norwegian citizens 20 years or 30 years from now, is gone. And I believe that you're going to see fairly massive disintermediation out of bonds and debt instruments by the largest institutional investors in the world, because they have to do it to fulfill their mandate.